Hello, everyone, and welcome to our webinar designated to help you and your organization to understand the opportunities of distressed M&A in Brazil. My name is Silvia Bernardino. I'm associate of Trent Rossi based in São Paulo, and I have over 15 years of experience in M&A transaction in Brazil. First, I would like to thank you for being here, especially in a Friday late afternoon. I would also like to thank the CCBC for the opportunity to be a speaker today, together with my other colleagues. And I would also like to thank the other speakers for being part of this webinar and to help us to discuss the M&A, distressed M&A opportunities here in Brazil. So basically, we divided this webinar in 3 parts. First, I will explain a little bit of the effects of COVID pandemic in Brazil and what the opportunities we have now. The due diligence aspects, what are the main points of concern and points to pay attention. the structure, how to structure the M&A transaction and the most common format of the transaction. After that, I'll pass to my colleague, Monica, to explain a little bit of the transactional documents and point of concerns. And afterwards, my colleagues from Canada will discuss legal aspects regarding the comparison of the M&A transactions in Brazil and Canada, and also the fiduciary duty of the officers. I would like to introduce you the other speakers. So Monica is an M&A partner of Trent Rossi in Rio de Janeiro. Nancy is a M&A partner of Baker McKenzie in Toronto. And finally, we have Michael, a litigation partner of Baker McKenzie in Toronto. Okay, so what are the effects of the COVID pandemic in Brazil? So even prior to the COVID pandemic, we saw a number of sectors showing signs of distress. Some already had a high level of debt. As the COVID-19 pandemic hit Brazil, some companies were fast in acting to preserve cash and ensure liquidity by making dramatic cuts and reorganizing. Some others took a little bit of time to take some measures. And all these contributed to have companies here in Brazil with different level of distress. Also, as a result of the pandemic, there's still a high level of uncertainty as to the speed of which the economy will recover. We had government stimulus packages, but as the time passes, they are starting to cease and all have a timing to be terminated, to be finalized. Also, credit from banks, government, and shareholders is limited. Some companies, depending on their size, do not have access to credit here in Brazil. And all these have contributed to the companies to have a different level of distress and tend to look for buyers and investors to change this scenario. On the other hand, we have investors with a degree of appetite for risk and cash available looking for good opportunities, especially for investors that can take advantage of the exchange rate for the exchange rate here in Brazil to invest in distressed M&A in Brazil. So today, 1 Canadian dollar is equal to approximately 4 Brazilian reais. Okay, so the scope of this presentation is focused on distressed M&A in Brazil of companies of different level of distress, but prior to a formal insolvency process. So it's good to be that clear, because insolvency process in Brazil has a specific terms to be done, and this was a scope of a different webinar. So what does a distressed M&A sale process look like in Brazil? So first of all, buyer has a difficulty to make a robust and defensible valuation, because it's hard to foresee the speed of the economy, the earnings of the company, how the global and Brazil will recover from this recession. Also, distressed M&A tends to be much faster than a regular M&A for several factors. So as the time passes, seller may face even more financial difficulties. The company wants to preserve its key employees, customers, suppliers, and have them supportive. And as the time passes, the image of the company because of its financial situation can be permanently damaged. So the process tends to be fast, especially when we have an auction with several potential buyers interested in this investment here in Brazil. And one other characteristic is the nature of the transaction. It's usually as is, where is. So as Monica will explain later, with limited or no reps and warranties and guarantees. So how do the due diligence aspects look like in a distressed M&A? So as we have the pandemic, most of the meetings are virtual, management presentation, even the negotiation of the documents and the due diligence phase. The volume of document available for the due diligence is usually limited, especially sensitive information. A physical visit or access to people are also limited because of the pandemic. And usually we have a very tight deadline. So in view of all the main situation, the buyer and its investors must to focus in critical aspects of the due diligence. So it's important to have advisors that are used to this process and can focus the most critical aspects to finalize the due diligence in a fast manner. So what areas to focus? I provided here some of the topics. So you want to make sure that you're acquiring shares or assets, depending on your structure, free of any encumbers. Change of control of material contracts, especially financing agreements with bank, and make sure that in case the transaction move forward, these consents are obtained. Also identify other liabilities such as tax, labor, compliance, because most of this type of transaction of distressed M&A, there is succession liability as a result of the transaction. And also check the insolvency. So you want to make sure that seller of the company is not insolvent at the time of the transaction, would not be insolvent after the transaction, and that the transaction is not intended to defraud, because all these can be causes of the transactions to be revoked in court. Okay. After that, we have the most common structure of the distressed M&A transaction in Brazil. So they are stock deal and asset deal. Both of them have advantage and disadvantage. So first, stock deal is more common in acquisitions in Brazil because it's less burdensome from a transaction point of view. And also, depending on the circumstances, it's more tax efficient. From an implementation perspective, it's simpler, involves less documentation, as you do not have to transfer each individual asset and title. So we transfer the shares, and it's a simpler process. In addition, as a result of the change of control of the sale of the shares or quotas of the company, the license and permits of the company would not be affected. And in a stock deal, you can have different types. So you can sell 100% of the shares of the company, or part of it, and have a new investor in your company and form a joint venture company. On the other hand, we have an asset deal. Can be more complicated. Depends on the assets you have to be transferred, because each category of asset has usually a separate procedures to be transferred. For instance, if as part of your asset you have a real property, you have to draft specific documents to transfer this property. It needs separate registration with the real estate registry, so it's more complicated. For foreign investors, foreign buyer, usually you need to have a Brazilian entity to purchase certain assets. So it adds a layer in the transaction. You have to organize a company in Brazil, and foreign investors need to have a turning fact here in Brazil. So documents from, if we're talking about Canadian investors, needs to be legalized, apostille, and there are several legalization process to have a company here in Brazil. So it adds another layer of timing and expenses. Transfer taxes may be triggered by the transfer of assets. And some of the public license and permits are not transferred as a result of an asset deal. So in addition, depending on the assets to be transferred, in addition to having a Brazilian entity, this Brazilian entity needs to obtain the permits and license required to have the assets as of the closing date. But it has some advantage, of course. So buyer can decide which assets it wants to buy, cherry picking, and do not need to buy the whole business. And in certain circumstances, a buyer is liable only for the obligation acquired. Of course, there are several exceptions, tax, environmental, labor, and others. So these are the main structures we have here. So I will pass to my colleague, Monica, and she will discuss the transaction documents and the main aspects.
Thank you, Silvia. Can you all hear me now? I was on mute.
Yes.
Okay, I told my colleagues that this should be the happy webinar, and we should have all our glass of wines with us with Friday 6 p.m. in Brazil. But it's a pleasure to be part of this and to discuss such a relevant topic with you today. My name is Monica, as Silvia already introduced me. I'm a partner with Rossi Watanabe in the M&A and corporate group. And I thought that first of all, I would take a few minutes to give a general overview of the distressed deal dynamics and the main drivers of such type of transaction in Brazil. The distressed transaction involves a company which is facing or anticipating difficulties managing its liabilities. So the company needs to restrict its debts and balance sheets. And the scenario that I will cover today at our discussion, as Silvia already mentioned, is in a situation in which there is no insolvency formal process yet. In this scenario, the company is in a potentially distressed situation, undergoing in a restructuring process to dispose of shares or assets on a solvent basis or to restrict its debts. So the deal presents similar characteristics to traditional M&A, but some key challenge, but the key challenge probably is speed and some specific legal considerations, which we'll see today. The unprecedented situation that we are facing, especially because of the COVID-19 situation, creates a number of challenges, especially when we consider seller's perspective under a financial distress deal. The immediate need for cash for the survival of the company is the main driver of this specific type of transaction. So I would say that timeline, valuation, risk allocation, and closing certainty are crucial factors and challenges to have the deal structured and completed. This was true before COVID, but after COVID, it's even more accurate. The stakes are higher because of this, the worldwide economic and financial uncertainty that we are facing. So we're about to see more small and mid-sized companies seeking protection against creditors and desperate for liquidity. They're likely to be good opportunities for buyers coming to the market with the appetite, willing to price the risks of a distressed deal and enter into a transaction with such an accelerated timetable in which speed is key. And post-closing protection recourses are limited. Good assets are available for competitive prices, and this represents a good opportunity, of course. Closing certainty is essential to seller because the death of the deal could represent the death of the company. So again, to smoothly navigate through the relevant challenges from a seller's perspective, sellers should, to the extent possible, try to control the agenda of the deal, dictating the time of due diligence, and having a seller draft contract and a less disrupting due diligence process. Those are challenging negotiation points, of course, because buyers tend to have more leverage as the pressure is on seller. The time pressure is on seller, but seeking to have as much control as possible of the deal dynamics and timelines is essential to guarantee the successful conclusion of the deal. In terms of valuation, sellers should always maximize the certainty of the transaction. Cash is king, and this is absolutely a must in this type of transaction. And earnouts arrangements, for instance, with deferred payment, are not attractive to sellers at all. So having this in mind as a background information, and understanding that the two main drivers of distressed M&As are transactional speed and maximization of closing certainty, now we can follow and discuss a little bit about the transaction documents. So the purchase agreement. The purchase agreement is not a typical purchase agreement. Time, as I said before, will always be a critical factor. There is less time to have unlimited negotiation sessions and back and forth with drafts, changing words and commas, because the time pressure and unpredictable circumstances caused by liquidity shortfalls very important to spend time with without having this focus on the outcome of the negotiation, but rather spending time with this go back and forth of drafts, etc. This is not going to be a 90-page long agreement with extensive reps, warrants, and all kinds of sophisticated indemnity mechanisms and guarantee baskets of guarantees, etc., simply because there are no pockets for sellers to be sued. So for all those factors, distressed M&A deal has a lot of particularities, not only under timing, due diligence, structure, condition precedents, and closing perspectives, but also, and I would say especially, contractual provisions, also for representations, warranties, and indemnities. This type of transactions comes with the risks, and this risk shall be taken into consideration by buyers who would need to be prepared to face an accelerated timetable and have the capacity to evaluate the risks and live with such limited indemnities and guarantees. So signing and closing of this transactions, the best scenario, of course, if at all possible, is to avoid having different moments for signing and closing, but rather concentrate all efforts to sign and close simultaneously. This approach increases the certainty of the deal and mitigates discussions over deterioration of the business, adverse change, or walk away from buyers. Targets performance, the company's performance that it's under being evaluated by potential buyer, can deteriorate very quickly. Sometimes it's not possible to have one single moment for closing and signing and closing, and it's okay, it's understandable, because depending on the specifics of the deal, there are regulatory approvals, third-party waivers, consents, authorizations, license, permits, etc., that needs to be granted or assigned. In this case, the time gap between signing and closing must be very limited because of the time pressure on the financials of sellers and the quick possibility to have the business deteriorated. Okay, so reps and warrants. Discussing about reps and warrants in this type of transaction. This tends to be very limited. These reps and warrants more limited because sellers will, of course, push to restrict these representations and warrants, targeting to include only the essential ones. The opportunity to acquire high quality assets at substantially reduced price is typically the main driver for buyers, investors. So everyone wants to pay the least amount to acquire the best assets. However, such opportunities come with the risk, so buyers need to have a higher level of tolerance to be able to follow a tight timeline and negotiate risk allocation for successes, liabilities, and contingencies. So seller's mindset is focused on liquidity and the need for cash and the deal, because of the need for cash, the deal must be closed as soon as possible. So there is no time for, as I said, long-lasting negotiation over all sorts of reps and warranties, which at the end could not really equals to an effective remedy in case of a breach, because there probably will be no guarantees available because of the financial condition of sellers. So because the target companies are being pressured by creditors, every hour counts in order to preserve value. And in this scenario, buyers should really consider whether warranties in a distressed deal will be of any real value, because a distressed seller may not have the financial resources to honor indemnity claim. So we talked about the purchase agreement itself, 2 moments, signing and closing, reps and warrants, and now let's discuss a little bit about how condition precedents would look like in a distressed M&A purchase agreement. As I said, the time gap between signing and closing uh, is uh, is something that should be very limited. So only essential condition precedents should apply in this type of transaction, and this should be very well negotiated and reflect into the transaction documents. The more objective we have the CPs, the better for both parties, seller and buyer. Timeline for the obtainment and fulfillment of the condition precedents must be strictly controlled by the parties to guarantee the success of the deal. The delay in this period between signing and closing and the completion of the condition precedents may adversely affect the valuation of the business and its continuation. So if in one side, seller, if the delay happens and the deal dies, and so probably the company, at the other side, buyer, if a delay happens, all the valuation and the initial assumptions that he took to calculate price and to enter into the transaction could be jeopardized. Contracts could be canceled, key employees may leave the company or may have to be terminated. So this is very important for both parties, having the CPs very well agreed, limited, and the timeline observed. So in terms of the CPs, only the essential ones for closing must be included in the purchase agreement, such as regulatory approvals, of course, and mandatory third-party consents. On the seller's perspective, sellers should consider to reject any CP that could delay completion and the payment of the purchase price. And it's also advisable to prepare a schedule listing very specifically each CP, and also agree on potential waivers in case a partial fulfillment does not jeopardize or restrict closing of the deal. Okay, so we cover the purchase agreement, signing and closing, reps and warrants, condition precedents. Let's talk about covenants that we typically see in M&A transactions. There are certain typical covenants that we see, of course, such as ordinary course of business, which can be difficult to negotiate in a distressed M&A transaction. Because the appropriate language for such provision, especially if the period between signing and closing is extended, it the provision should only encompass extraordinary situations, because some decisions and actions sometimes must be taken by the officers, by management, to preserve value of the company, especially because of its financial conditions. So sellers will likely be prohibited from granting new debt secured, for disposing its assets, for paying dividends or distribution to shareholders, for paying loans, participating in group cash pooling arrangements, etc. But sellers can also seek specific carve-outs aiming to capture actions which the seller target business is compelled to take in the best interest of the business. Material adverse change and material adverse effect is also something that it's a clause that we see in typical M&A transactions. It's hard to negotiate in any type of deal. We know that. In a distressed deal, it's even more difficult. The change on the previous condition of a business or assets must be something absolutely substantial. Otherwise, this could be a way out for buyer, which could kill the distressed party and the financial stressed financial situation, and also on the reputational perspective. So as to my clauses, the concept of materiality in the context of a distressed deal is a higher bar in terms of magnitude and duration of the effects, the adverse effects, having to drastically change the previous situation. So a transitory event would not be enough to invoke a MAC clause to terminate a purchase agreement where buyer was aware of the circumstances that seller and the target business were facing. So this, if at all, could be, if at all, negotiated and included in the draft, in the purchase agreement, should be really, really material and substantial. Okay, so in terms of indemnification and guarantees, we know that this type of clause is always difficult also to be negotiated in a standard M&A deal. We have long-lasting discussions about the scope of indemnification, types of guarantees, restrictions, limitations, etc. And this, in the case of a distressed asset, is also very difficult, because a buyer must be prepared to wisely calculate the purchase price and do the risk assessment, do a very good homework, since almost no indemnification protection will be available. If lucky, you can negotiate as buyer a limited escrow, but it's very unlikely that a buyer will get a substantial amount in an escrow or even a guarantee at all. So in those cases, insurance could be an option. Any limitation on liability, if indemnification clause is agreed and it's foreseen in the transaction documents for distressed assets. So if any limitation on liability will be more seller friendly, meaning that caps, baskets, de minimis, time limitation, etc., will be more seller friendly. Buyers should consider in this case to price the risk or try to negotiate a holdback of part of the consideration to deal with the contingencies and the risks that were identified in the due diligence. For obvious reasons, sellers may be reluctant to agree on any form of deferred consideration as holdbacks or escrows. Okay, so I think we pretty much cover the main clauses that we have in a typical M&A transaction. And this, now we will talk about anti-embarrassment provisions, which is not so typical in standard M&A transactions, but in this type of distressed transaction is common, because it's, and it's on seller's benefit. The provision will apply in the event of a quick flip of the target business by the buyer for a significant higher price. It the provision foreseen the requirement that the buyer makes an additional payment to seller. The anti-embarrassment clause will give the seller some of the upside if buyer in a short period of time benefits from a higher price for the assets. So whether buyer will accept it or not will pretty much depend on the dynamics of the negotiation and the leverage of each party. I think that we pretty much covered all the main aspects of the transaction documents, having this comparing to the traditional M&A and how sellers and buyers should be prepared and understand the dynamics of the negotiation and the deal and the provisions of the contract. So from my side, I think that we went through the main significant clauses and difference.
Okay, thank you,
Silvia,
Monica.
you're welcome.
I think now we're gonna pass to Michael.
Thank you, Silvia. Hello, everyone. So my name is Michael Nowina. I'm, as mentioned, a partner in Baker McKenzie in the Toronto office. My practice is focused on restructuring and insolvency and litigation. And I've been doing that for almost 17 years now. But it's hard to believe it's been that long. We certainly find ourselves these days in very interesting times, and probably unlike any other recession that most of us can remember before. Unlike in the United States, where we're starting to see some very high profile Chapter 11 filings get made, in Canada at least, corporate insolvency filings are substantially lower, and they have been substantially lower throughout this period of the pandemic. For instance, in July, there were 42% fewer filings than there had been in July of 2019. And that's a really interesting statistic when you think about it, given all that we're going through. There is an uptick every month, however. There was 3% more from June, July in Canada. And the general expectation is that filings will continue to increase. There will be more distressed businesses as government support for the economy starts to be rolled back. But needless to say, we're living in very unusual and uncertain times, especially for businesses that are trying to make investment decisions. So what I'm going to speak to you about briefly is just an overview of director and officer duties in Canada and some of the considerations that they should give when they are looking at a distressed M&A opportunity. So under Canadian corporate law, directors and officers have two key corporate law duties. The first is called the duty of loyalty, which isn't so applicable here. The second, that is more applicable, is the duty of care. And this duty of care requires directors and officers to be diligent and to have the skills that a reasonably prudent person would exercise in similar circumstances. So I put up on the slide some of the things that directors and officers have an obligation to do. Probably the biggest and most important one is devoting enough time and attention to the corporation's affairs, giving critical thought to important issues, which obviously any decision to pursue a distressed M&A opportunity would be considered to be a very important and critical issue. And for directors in particular, it's having the knowledge and understanding of the business, as well as the business that we might be acquiring, to properly oversee the decisions that management is taking. So from my perspective, to actually make this a little bit more practical, I've put together on the next slide a list of questions, which I think that will help guide the sort of decision-making process. So these questions are simple, but when you start to unpack them, they become more complicated. You know, how the distressed business got into the situation it is. It's very easy to receive, superficial answers about COVID or the slow economy, but really a closer examination will often tell you that the surface reason for why this is a distressed business is not the real reason. You can have a failing product line that's bringing down successful business, or maybe it's simply poor company management that is spinning the company off in things that it shouldn't be doing. And the second question about what can you change, this is probably the most important thing for directors and officers to think about. Right-sizing the company by changing its workforce, changing its capital structure, renegotiating historical liabilities, or simply dropping unprofitable locations or business lines should be at the forefront of any decisions made about distressed opportunities. Because what you really need to do is, what has to change, what has to go right to make this a profitable business. If your approach is going to be the same as the previous owners, it's probably not a recipe for success, but you should have a pretty clear indication of what success will depend on, because obviously if 2020 has taught us anything, it's that unforeseen events do occur and they can last for a long time. So my key suggestion to you is the most important thing is always to have a process to evaluate the distressed opportunity, and that protects you in a number of ways. Firstly, it's a good thing to have just to guide the process, but from a litigation standpoint, courts typically focus on reviewing the process undertaken by directors and officers before a decision was made. So as long as you have a process that's reasonable and follow it, Canadian courts at least are unlikely to second guess any business decisions that get made, even if they don't work out as well as you anticipate or hope for. So from high level, that's the key considerations that directors and officers should consider when they're looking at distressed opportunities. And I'm now going to turn it over to my colleague Nancy to highlight some of the differences and similarities between Brazil and Canada.
Great, thank you, Michael, and thanks so much for having us. I think we're very excited to be speaking with you this evening, and as Monica said, I think we're into happy hour, so hopefully you're enjoying a glass of wine while we do this presentation. Generally, I think my colleagues covered the substantive items. I think I just really wanted to highlight some of the similarities and maybe some things to watch out for in this environment that we're in. So the first thing is that generally what Monica described in terms of the reps and warranties, indemnities, and other aspects of the transaction documents are very similar to what you would see in Canada. The process is not very different in that respect. And I think a few things that Monica mentioned resonate and are going to continue to resonate as we see an increased number of deals being done in this distressed context. Speed, certainty, and then the other thing to consider is the simplicity in structure. The last thing sellers want when a buyer comes in is a complex structure to address what purchaser might desire most. Interestingly, though, I think that we're going to enter an environment where these businesses that are being sold or that are up for sale are not necessarily being sold because they were run poorly. They're being sold because of COVID-19 situation that's hit them quite hard. And so there's usually going to be a lot of opportunity, which means that on the sell side, these assets may actually be quite lucrative once they fall into the hands of somebody that has cash and an interesting appetite for risk. So what I expect to see is obviously as more lucrative assets and businesses start going up for sale, I'm expecting to see a little bit more competition on the purchaser side, which is why it's important to have a deal team on the purchaser side that's experienced and that can quickly identify what's important to your business. Obviously, from a legal perspective, we think things are very important. We think, you know, regulatory aspects are important, contracts are important. But when you're looking at the business that you're buying from an operational perspective, your risk tolerance may be different. And you need to know what that is before you go into acquisition mode. And the reason that I say that is because if you can act quickly, to Monica's point around speed, if you know exactly what you need to focus on in due diligence, and if you can quickly structure these transactions so that they're easy for the seller to execute, basically you can win out. And one of the things that I think we will also see are, especially for assets that are, again, more appealing to a vast majority of investors, I think you're going to see truncated auctions where sellers are going to need to find a way to maximize the amount of money that they get for their business, and also ensuring that the transaction meets their needs. And so I do think we're going to see some increased activity in that sense. The other thing is, historically, about 80% of deals globally have been share transactions, right? But for some businesses, it may actually be better to have asset deals. And at least in Canada, we're seeing a lot of asset transactions. I think in Brazil, asset transactions sound complicated, but in situations where what's being sold may not be as appealing to purchasers, I think there will be an appetite to do asset transactions so that purchasers can basically cherry pick, as Silvia said, what they want. And I think that that's something to really watch out for. With the rise of asset transactions, one thing that we are seeing globally are carve-out transactions. Obviously, sellers that have multiple businesses are looking at what is considered their non-core businesses and thinking about ways now, prior to what I would call the storm coming in the fall, right? The reality is a lot of companies today are not necessarily at the point where they're really distressed, but they know that they are going to be hitting that point in the fall. Once government funding and subsidies are removed, I think they're gonna have some trouble. And what we are seeing is companies planning ahead. So they are doing things like carve-outs, trying to think about what are the non-core businesses that they can hive off and have stand independently so that purchasers can come in and buy them, whether that's a strategic investor or whether that is a purchaser that is going to be coming in as an investor to just buy the business and then hopefully in the future flip it. Probably making this kind of an ideal ground for private equity clients mostly, I think, in the carve-out space. So those are some of the trends that I think are coming down the pipeline. I think we've already seen some of that in Canada, and I think we're going to see that globally. Things to look out for. The one thing to keep in mind is that rep and warranty insurance is not eliminated in the context of a distressed M&A. We've seen companies like Aon and AIG actually come out and say, we recognize that there's going to be a reduced number of, let's call them standard M&A deals. Well, these guys are still in business of making money and they need to figure out how to sell insurance. And so what we are seeing is these insurers be willing to talk with buyers about how to insure distressed M&A transactions, because that's going to be the volume of the deals to come. And so what I would say is early on in the process, if you are interested in coverage, we can obviously help, but other advisors should be able to help you get in touch with insurance brokers and insurers to see whether you can get some coverage and some sort of security from a rep and warranties perspective. The other thing is, and Monica mentioned this, the anti-embarrassment provisions. This is a sell-side tool. It also plays a little bit into what Michael discussed, which is directors' fiduciary duties, because it protects the value of the business. But the one thing I would say is, while purchasers may initially be reluctant to offer this up, if the asset is lucrative enough and if purchasers really want it, this may be something they just have to give. And part of that is to also protect the directors of the entity that is selling the assets. And so that's something to keep in mind that I think obviously is very different from a standard M&A transaction, but that I think we're going to see more of. And potentially it'll be interesting to see I think down the road, if these provisions get litigated, what will be considered a reasonable duration of time, what is considered a high amount for this to be paid out. But I do think that we're in for an interesting ride in M&A generally. And so these are just kind of some of the thoughts that we wanted to share with you and trends that we've been seeing both in Canada and globally.
Thank you, Nancy. Thank you all. We'll receive some questions here. I think we would not have time to cover all of them, but maybe one or two. So I'll read the first questions. I can provide initial thoughts, and my colleagues feel free to complement. So our first question is that, what kind of assets are more suitable for Canadian companies to purchase regarding a synergy point of view? So historically, we see investors interested in infrastructure and renewable energy here in Brazil. But we know when it comes to distressed M&A, it all depends on what kind of interest the investor has and prior experience. So it all depends what is the business of the Canadian investor. And I don't know if Monica wants to complement.
Yeah, Silvia, I think you cover, I think the what we call EMI, energy, mining, and infrastructure would be the most desirable or assets that we could imagine that we should have synergy, Canada and Brazil. But I do agree that really depends on the industry, on the type of assets available. Sometimes it's a possibility to enter into a new market. So and you have assets available that would not be there, or companies that would not be there because if it was not this financial crisis. So it all depends on the strategy, on the business strategy of each company. But as generally, I would say I agree, energy, mining, and infrastructure would be the top ones.
And also the appetite of the investor for risk, because we have companies here with different level of distress. So it also depends what type of risk the investor wants to take. Thank you for this question. The next one is a question from Dr. Marcelo. He mentions that our webinar is very interesting. He is having an experience of an M&A process with a Brazilian company. And in his view, the process is very slow. And he's asking how this process can be speeded up here in Brazil.
This one is easy, Silvia.
So go on,
Dr.
go
Marcelo,
on.
you just have to contact us. No, go ahead. Just kidding. Go ahead.
No, yeah, feel free. But as a general comment, we provide how an efficient distress M&A will work in Brazil to preserve the financial situation of the seller. But of course, we have all types of and also other point, you must have buyer and seller, specialized advisor in distress M&A that understand how its function and how the negotiation goes and what is the critical aspects. But of course, we can find situations of the companies or sellers that are not used to this process, or advisors that are not used to this process, and they might not be focusing that the time is of essence and the financial situation of the company can be damaged very fast.
I agree. Yes, I agree. In my experience, what we see is sometimes companies come into the process with not being prepared. Either because it's a new scenario for a company, or because it's not a sophisticated player, or has not the right advisors hired to help them. So it begins the process as M&A process, as stressed M&A process, even more important to pay attention to this timing and to the organization, to the preparation for the process itself. So you don't have to begin without being prepared. It could take even more time than first do your internal exercise, organize your own house, then begin the process itself. So I would say that I agree, Silvia, I agree with the points that you covered.
Okay, great. I think we do not have questions regarding the scope we presented here. I would like to thank you everyone for being here and for our speakers. It's a great pleasure to be here. We hope this webinar was useful for you. Of course, if you have any additional questions, you can contact any of us. And also thank you again, CCBC for having us here and for this great event. So thank you, everybody.
Thank you. Bye-bye.
Foi.
Ciao, ciao. Bye-bye.